Good evening, guys. Thank you everyone for joining us tonight. And I must, before I start, I would like to wish everyone Selamat Hari Raya. And it has been especially a great one for myself. I hope that's the same for everyone. My name is Adrian. I'll be your moderator tonight. And tonight, we will be hosting our second quarter Malaysian market outlook with Peter giving us the insight on how to navigate. But before I jump to the introduction for our speakers, I'd like to highlight that myself, Peter, and our gorgeous Isabelle are all licensed by SC. And yes, that is how serious we are in this, how we take things really seriously, right? Although I'm a bit cheeky. But yeah, that's about licensing. And yes, you are in good hands. So Peter is our head of research, where he has a multitude of experience under his belt, from an accountant to a debt analyst, and now he's our head of research. And he has been exceptionally responsive to the tariff war. I can see him coming out with reports almost every week on a strategy on how can we navigate. So let's set some ground rule tonight. Let's if you have burning question, do put it on a chat. I'll say hi here. Hello. And at the tail end, once we are done with a quick Q&A, Isabelle will be showing us on how can we relook at call warrants in this time where the market is extremely volatile, and how can we take advantage of the volatility. Yes. So before I go forward, this is something nowadays we are all required to do. This is a disclaimer that I've been actually posting. Normally what I do and what I get people to do is print a copy out, reread it. But yes, it is mandatory. Yep. So let me jump to the next slide. So this disclaimer in summary is like we must be kind of responsible of what we do in a way. Yeah. Yes. Okay, coming to the awards. I am actually really excited, for 2025, because I'm thinking, how can we outdo ourselves in 2024? So I'm actually looking forward to update this slide here. And the reason why we have been winning so many awards from mainly from the other teams, that is because we have always been striving to improve ourselves, where you guys are our main motivation to serve you guys better. Yep. Okay, coming down to one of the products that I think in a volatile market that we advantage on is actually our KDI Go app. You can actually scan on the top right screen where you can check it out. I personally use it and I max out the try to max out the percent. It's really hassle free. Try to max out $1. Something special before we ease into Peter's session and subsequently Isabelle. I would like to guide you guys to show you guys a bit on the chart where I think it could be more relevant also at this time where timing do matters. So what do I normally do on a weekly basis, as I actually also give out talks on a weekly basis, only for our clients and also dealers and remisers. And yeah, on a weekly basis, and we do chart reviews. So I do cover Dow Jones and Hang Seng, SGX, and also KLCI. That's home ground. Definite, must cover, must do. And we love Malaysia, right? So yes. On a quick one for Dow, that's weakness. So the chances of it coming down is very high here. You can see it has broken the support level again. So it's actually, there's a high chance of coming down again. So in the middle term and the near term, be very careful. The stochastic is also looking to turn. So if you have a lot of exposure, you might want to reconsider and re-strategize. But for those that have no position, you can start strategizing if you should accumulate. Yeah. If any case this round, if the volatility sustains, it might go down further here. Yeah, that's for Dow. Hang Seng, on contrary, is actually a bit divided because you can see from here, it's actually forming a really interesting formation, and it's actually sitting on top of the 21,000. So there could be two scenarios, either up or down. I'm actually stating the obvious, right? But this is where we must be prepared. So if it's a breakout, there's a good potential to participate in a call warrant. But if there's a breakdown, you can actually know what kind of put warrants to check out. If you tune into, you can check out our Telegram and Naga warrants, which is in the link on the chat too, right? Check it often, because if you like call warrants, we do have some promos sometime, and you can actually PM us too. Yeah. So for me, I think that the probability of sustaining above 21,000 is a lot higher, and there will be continuity also to go up. That's a view. And yes, we are allowed to give you, because we are licensed in our specific field, right? It's a bit different. This Straits Time Index, I think there are a lot of value stocks to actually look at in Singapore also. There's a big gap here. The banks are recovering, but at the same time, you guys can check out stocks like Keppel, SATS, Samcorp. They're actually good names. So the rebound here, I think it might take a break, but it should sustain above 3,007. All right, KLCI, there's a bit of weakness. So the middle term view is it needs to stay above this critical level, 1478, and if it does, we have a good chance of coming back. If it doesn't, the prolonged weakness will be there. But volume is actually really low. So I think unless there's a lot more dark swan event, or someone just couldn't keep his mouth on very crazy move, I think the pressure has eased off. So let's take a step back. Okay, I shall pass the floor to Peter, but before that, I want to thank everyone for joining in tonight, because an investment in knowledge pays the best interest, and I'm really, really glad that you all tuned in. And again, thank you. Peter, the floor is yours. And before that, there's one more thing to highlight. We'll be giving out Shopee vouchers. There's 5 of them. Each of them is 100 ringgit. There will be 3 Shopee vouchers for those that complete a survey at the tail end, and 2 for Naga these are from Naga warrants, and for 2 question asked that is going to be posted in the chat box later on. So do stay tuned to the end. There will be more excitement in store for you guys. All right. I think I take a bit long. So there you go, Peter. Thank you.
Yep. Thanks, Adrian, for that wonderful introduction, and good evening for the dialers who have chosen to spend the time with Kenanga at this tumultuous part of the trading month. I would say that when I first was asked to come on to this presentation, it was supposed to be a second quarter 2025 presentation, but US President Donald Trump has decided to entirely hijack the talking points, and it's all about him, right? And therefore, my presentation today would also orient in that way to help understand what is the impact of the Trump tariffs, and how much damage has already been done. Is there a need to so-called run for safety, run for the hills? And in between all this turmoil, are there stocks that are already worth taking a look at? So these are some of the questions that we want to go through. At Kenanga, I think just as how Adrian have correctly put it just now, the risk in the market is real. So everyone hope you all to stay safe, stay calm, and I'm here to just share more insights and knowledge for you to make a good investment decision. I think I would just like to be a bit more structured today to spend the time with you to distill what we believe is happening at the moment. Of course, Trump front and center. We will have to talk about the tariff. We call it tantrum, and we all know that we have seen the news. We have heard of what is the tariff rates that are being slapped onto Malaysia and all the countries around this region. So I think most of us on the call would have already seen the news on the newspaper on this. But what we try to value add tonight is to tell you what sort of leverage Malaysia has and how do we think about the economic impact. So that's number one. Having then laid out the economic picture, that's where my job as strategist is to then decide how we should position ourselves if we have a portfolio of stocks, and within that portfolio of stocks, how should we do our stock picking strategy as well. Further than that, I think we want to bring some value add to our investors today, because I think for the investors, what we see from the market is the investment community. Then we ask ourselves the question, whether is whatever the investment community is seeing, is that exactly what the corporates or the people who are deep in involved in tariffs or could be impacted by tariffs, what is actually their response? So that's why we are here to talk. Give me a few minutes, and then I'll share with you our survey outcomes shortly. We are also at the stage of the economy that we have seen in the recent weeks a lot more buying into so-called safety stocks, right? So we have seen REITs do relatively well, telco doing relatively well. To some extent, previously, fund managers were just racing to acquire healthcare, for example, which are sectors that provide relative stability due to structural and secular demand, which is not affected by cyclicals. But I'm pretty sure amongst us here, a lot of us were also exposed to some level of cyclical stocks. For example, property, construction, and most of all, banking, for example. And this is where we should be a little bit more careful because of the growth concerns. And that's where we think that it's useful if I was to also bring us through some form of scenario testing for the sectors that are more cyclical. So I'll go through that as well. Then, of course, finally, we will talk about stock recommendations. What do we screen for? What have we looked at that looks quite bombed out at the moment? How do we pick our dividend stocks? So all these things we will go through within the time of perhaps the next 1 hour. Right. With that, let's dive into it. Yeah, I think perhaps I will just start today's meeting. Maybe I will just break the rule a bit. I will just go with item C, right? Survey and ground checks. So over here in Kenanga, we cover over 120 stocks. We have actually upon hearing about the reciprocal tariffs, what we immediately saw was the market went into some form of like a panic, right? Because the number, which was widely expected to be a cap of 10%, and this is US commentators, right? They believe it was going to be about 10%. When it was eventually announced, it was this really unexpected formula that US President Donald Trump was showing in front of the Rose Garden for all of you who were watching it on the TV. And the formulas that were being applied prescribed that Malaysia was at 24%, and some of our peers are even at 40 over percent, 49%. So that was a great shock. and markets just went into a bit of a fearful mode, and started to sell relatively indiscriminately, right? And our CI also dropped at one point to 1,300 levels. So I think at that point in time, as the research head, I just asked the team to go and ask to see what is their initial assessment of what's happening on the ground. Okay, so maybe I'll just start tonight with a teaser to all of you who are here. Perhaps the next few seconds, you just choose and see what will you choose, right? Do you believe that the tariff that would be eventually negotiated, for example, between Malaysia and US, would land at 20? Will it be 10%? Will it be between 10 to 24%? Or will it be below 10%? Right? So let me repeat that. Do you think that the tariff will end at 24%, 10 to 24%, at 10%, or less than 10%? Now, if you said less than 10%, uh, you are optimistic, but that's incorrect. Based on our survey that we have managed to get from 20 corporates, and we chose these corporates because they have regional exposure that is directly or indirectly related to the US. We have asked them the questions, and only 2 of them said that it would be lower than 10%. In fact, my point here being at the one in the I put it into 3 buckets. The one in the red over here are those that say it's a majority, and they have said that it would be between 10 to 20%, 24%. So it'd be lowered, but to 10% or more. So that's still the what we get here is that the Malaysian corporates are quite realistic. They are not painting a very hopeful picture as an expectation. Obviously, within this turmoil, later when we go through sectors, feel free to ask me, but my analysts have also gone and canvassed more responses from the corporates to see what they are initially trying to do. But one of the questions we ask is, currently, because of these tariffs, are you seeing more inquiries or less business inquiries? It is to no surprise, I think over here, some in the tech sector and manufacturing and gloves are seeing that. In fact, in the tech sector, what these companies comprise of is the likes of EMS, or those that are contract manufacturing, right? So names like PIE, names like NationGate, they are seeing more inquiries. In fact, what they are seeing is themselves being asked whether they can set aside additional capacity. These are so-called the rerouting sort of strategy, whereby because Malaysia, if we proceed at 24%, we are still lower than some of our peers like Vietnam, like Thailand. So for those reasons, they have been getting a lot more inquiries. For manufacturing and gloves, I'd be happy to share as well on this call. Our analysts have also spoken to some of the glove players. I think at this juncture, they have been seeing more inquiries that have been asked of them for the US business. Just that at this point in time, as far as I'm made aware, the orders haven't really come in yet. So how I read it is that if people are really betting that the 10% tariff is going to go away, then perhaps that's why they have not really put in their orders yet. Otherwise, it could also be a read-through that they still have quite a fair bit of stock, and therefore they have not been aggressive in ordering despite the 90 days pause. We can talk about gloves later. It is one of the sectors that we still like because of the developments on tariff. Now, as most of you know, tariff is paid by the buyer in the US. But currently, what is also a second order risk is what happens if the buyer in the US is unable to fully pass on the cost of the tariffs. So we also asked us the same question to the corporates, and the corporates have replied to say that there could be a chance that their own margins might have to suffer. If in case, for example, that if they might need to lower ASPs or give discounts. So, but happy to report right now that about close to 20% of responses say that there could be some margin pressure, but otherwise the rest of them don't expect margin pressure at the current moment, right? So I think just wanted to flash out a few slides to give you a sense of where the Malaysian corporates are at. Now, after a simple warm-up, now let's get into something more meaty. I think the first thing about the tariffs is that we all know that Malaysia needs to go and negotiate with the US trade by the end of April. It is not yet known. I think based on latest readings, right? When is the date that we will get in line to have that conversation? But suffice to say, on Kenanga side, the econs team as well have come out with a report to say where is Malaysia's leverage and strength. We have always known Malaysia's centrality or neutrality position is one of the strengths. I think that is quite commonly known. What is perhaps a little bit less well known is some of the facts that we lay out here. Electronics hub, yes, that is one of the areas. And when we talk about partnership and opportunities in the report, we will see that we no longer talk about China plus one strategy, but now we're talking about China plus one, right? So I think we have moved, we are one more step more removed than the countries that are traditionally seen too close to China. For example, the likes of Vietnam are within that original China plus one. So I think the mentality right now is that we are the China plus one and plus another one, right? So that's where we can take advantage of the manufacturing abilities that we have. And of course, those who follow the semicon industry will know that we are a huge semicon player and we have about 6% of the OSAT market. But there's also a statistic here that we provide about 20% of the within the value chain of US chip imports. So it's no small number that we are involved in 20% of US chips imports. And for that reason, it is definitely a bargaining chip that we will have as well. Excuse the pun. Right. In terms of the third thing over here, which I don't think is being talked about at the moment yet, is because it could be a bit controversial. We talked about the rare earth elements, right? So rare earth is used in electronic vehicles, technology, defense. So I think it is a very important critical mineral. But at this point in time, US imports are very reliant on China. About 78% of what they need come from China. And because of that, right now, those who follow the news quite closely will know that China said, hey, we will not retaliate anymore beyond 145% tariffs, but we might have other non-tariff measures, such as export controls, and we might not give you our rare earth anymore, right? So in that sense, Malaysia, as you can see here, we actually have quite a significant rare earth reserve of 18.2 million tons. And we believe that if we negotiate properly, we can actually use this and play a very strong hand to say that this can help US in terms of its security for rare earths. Now that's one view. Currently, of course, we do not mine anything from the floor, from the ground in that sense. What we have is a processing license with Linus. So that's perhaps where we can take this moving forward. And of course, in the area of rubber gloves, US currently has about 80 billion pieces a year of demand. Malaysia, specifically, all the Malaysian companies combined, your Kosans, your Top Gloves, your Hatas, and all that, should be around 50% market share. So meaning to say that if we have got a significant amount of quantities of glove that they need, we believe that if there's a preferential access for the US healthcare in this area, that this could also be used as a leverage in our view. So I think this is, having said all this, it's just to give us the viewers today a summary that we do have leverage. And we should be able to use this to our advantage to negotiate down our 24% that is being slapped on us, whether or not it will eventually land at so-called a base tariff of 10 or lower. Obviously, that's a bit hard to know at the moment, but we will go through the view right now. But suffice to say, we do have that bargaining chips that we have onto our favor. We think that the impact of the tariffs will cause the demand side to weaken in the US. One of the thematics that will emerge is that we think that the US dollar weakening is going to benefit EM currencies. So emerging market currencies will be strengthened for that reason. And we think that the ringgit will end at 445 this year on the back of no OPR cut. We think that the US will still cut at least 2 times. And although if you look at the market at large, market participants expect about a few more cuts. We think that then, sorry, I have a typo here, and 4.2 at the end of 2026. We think that on the reciprocal tariffs, if it stays this way, we are more diversified and we are better versus peers. We are good at the China 1+1. And obviously, whilst we have foreign outflow of equities, actually our bonds are being bought up quite well. That also means that, our borrowing rate wouldn't suddenly spike. That's actually quite healthy, because money is still coming in. There's no net outflow of money, unlike previous crises where US dollar dominance was very, very apparent. So I think on that, our responses is what are we watching out for? So let's say, for example, we believe that BNM's hand will be forced to act if the growth comes in 4% or lower for the year. We think this will happen, but the bigger critical issue is the second half, not the first. Because in the first half, currently in the first quarter, we believe most of the indicators should be good. This is also because front loading is currently happening in the first quarter. We think that the tech stocks, for example, all these export stocks, first quarter results shouldn't disappoint, touch wood, of course. But in the second quarter, this is now where things are maybe a bit slower because some of the importers are betting that the tariffs could come off. People are just surviving on existing stock. So for the first half, we believe that if you average it out, it will be all right. It is the second half that we're watching for. We think that if the Bank Negara has an indication that there is only a 3% year-on-year growth for the second half, we believe that would be an indicator for Kenanga to call it an OPR cut. Currently, for those who survey the market opinions, and I think market is relatively divided in terms of whether there will be a cut or not, and we defer our view to this indicator. If the second half is about 3%, then we think that the prospects of cut is there. Now, of course, subsidiary rationalization, we think that it will still go ahead in our view, although we know that on the ground, people are saying that it's not a good time to do it. We believe that at this price of crude oil around the 60 to 65, this means that our pump prices will be no much different even if subsidy rationalization were to be removed. And that means that it's the best time to do it to feel less of the pain. This also will influence how we view the economy because our inflation forecast is 2.7 with the subsidy rationalization of around 95. If it doesn't happen, we think inflation will be around 2%, and that also could give Bank Negara a bit more reason to cut rates, in our opinion. So I've gone through the econs. I probably now start to talk about equity strategy. I'll spend about 15 minutes here, and then after that, we'll go into some sectors and some Q&A. From the equity strategy, I like to say that we're not running for the hills, meaning to say that our portfolio is not strictly a defensive only one, but we're looking for a quality bargain. At this juncture, we have to admit that and eat humble pie a bit that there were some sectors that we liked previously, and that has not materialized because Trump has thrown a spanner in the works with his tariffs. Some of these areas that we have downgraded is because we think in the next 3 to 6 months, without the clarity on the macro, some of these stocks, although they are very cheap, we don't think that they will perform. So for those reasons, we have downgraded some of the sectors. For example, oil and gas, for plastics and packaging. But we have also, as I mentioned, we kept our gloves as an outperform. We have also taken the opportunity to look at stocks that are quality, give you a decent yield, And these are the stocks that we think that it is a opportune time to edit and accumulate when the valuation bands are quite cheap. So for example, CIMB, we have upgraded to a buy. Inari, we have upgraded to a buy as well at around the 180 sort of target prices. Around sorry 180 sort of share price. We have also due to share price weakness upgraded Kejaya Prospect, which gives you a good yield, and also Petronas Dagangan. As you know, Dagangan is one of the stocks that is normally associated with retail petrol pump prices. If there was subsidy rationalization, usually it'll be affected. But this is so-called a hedge, right? If the subsidy, the rationalization doesn't happen, people will be like, hey, this business should do well, and the risk is removed. So I think that's also one of the reasons we upgraded PetDec. However, one of the casualties of Trump is Bursa, as we believe that even just yesterday, I think it was quite one of the recent lows in terms of market, what we call average daily value. I think it was around 1.6 billion or so. So market participation is really low. There is no sentiment uplift as of yet, and we believe that market forecast of earnings is still too high. This is because we go through all the daily value traded, and we are able to tabulate the first quarter. And when we extrapolate it, we find that earnings cuts will be on the horizon. Having said that, I think those are just some of the high levels. Now we're talking. Now I'll show you some interesting charts, and hope this will be helpful for you. My tone so far has been neutral to slightly negative. Just that I don't think that it is a very bad case scenario. This is a chart that I like to just share to start off the so-called equity flows discussion. Trump 1.0 and Trump 2.0 is not really comparable, because in the 1.0 trade war, it was very targeted. A boxing match with China. In the second iteration of the trade war, he seems to want to reorder the whole rules of trade in the world, right? But I think some principles are still somewhat useful guidance for us in that when we compare the first 100 days of the trade war 1.0 and 2.0. Now, the one that is on the bottom is actually trade war 1.0. If you recall, it started somewhere around March 2018. And then that was when steel, aluminum tariffs first came in. And within about 3 to 4 months afterwards, we saw the moment that big countries like China, who promised to buy more goods from the US, and trade talks were proceeding in Beijing. And we know that subsequently there was a reduction in the scope of things that were being tariffed. That was when the market, and over here I use several markets, Jakarta, Philippines, Thailand, basically whole of ASEAN, start to find its footing and moved up again. This is not to say that 2.0 is similar to this, but it's giving us the sort of an indicator that when it recovers, the ASEAN region will recover normally in unison. But at the same time, when the bigger boys, such as US and China, are willing to so-called come to the discussion table, that's where I'm willing to put out my view that, that's probably somewhat the trough, right? Of where the fear is, and after that, confidence will come back into the market. Are we there yet? Perhaps no. That is still the $1 million question, right? When things will finally turn up. But I can say that it has been already very bad on a historical context of outflow when it comes to foreign investors, right? So this is a chart that is useful. misery loves company a bit. So I decided to put Malaysia together with Jakarta, which is Indonesia, Thailand, Philippines. We know that this is in US dollar terms, and this is the monthly outflow, right? We did see that Malaysia was one of the worst outflows in the month of March. And right now in the fourth bar here, it started off being a little bit less worse, but we are still feeling it. Across the region, it is the same. No country right now seems to be being able to mitigate so-called this outflow in its entirety. It looks a bit scary, obviously, but that's why the important point to note is that there are some sectors that is seeing a little bit more of this activity, and let's go into that. I think generally this is more Malaysia centric. Those who follow the Malaysian equities fund flows will note that year to date about 10 billion ringgit is outflow. As you can see, this is represented by the gray bars down here. We have seen that continuing since September. So really, guys, this is an environment we need to be a bit more selective, a bit more playing it a bit more safe. I think also from a foreign shareholding perspective, if you have these stocks at the moment, what we are just trying to show in this graph is the actual foreign shareholding, which is shown by the red bars. And these triangles is actually the change from 2024 peak. I've shown it on the inverse, meaning to say that if I was to say here, let's say TM, right? TM about 2.5% means it has been lower by 2.5% from the peak in 2024. Why this is a useful chart is just to give investors a bit of a color where the foreign activity is the fiercest. On this end of the spectrum where there is much less selling, we see that in the telco space, CDB, Axiata actually minorly improved their foreign shareholding. The consumer-based banks like Hong Leong Bank, Public Bank are also far more sheltered. Of course, on the other end of the spectrum, those that have fallen a little bit more, the likes of the YTL Power, SIME, those are on this end. I think the reason why we put out this chart is two-pronged. Number one is to show what is the absolute amount of foreign shareholding so that you can make a judgment whether it is still high and how much has it already fallen. It will also help to maybe allow for me to make a conclusion or help make a conclusion that we are not yet at the point where our foreign shareholding in has fallen to a level that was before our re-rating, right? So let me just rephrase that. Our foreign shareholding has come off, but and I use bank stocks as a proxy over here. So these are in percentage points, and these are the anchor banks that we cover. As you can see, the rally up for foreign shareholding really came in 2024. And whilst it's come off a bit, it is not conclusive to say that they have dropped to a level where, wow, it's before it re-rated, right? Means whoever who came in have already left, so things are very safe. It's definitely not the message we are saying, but what we are saying is that some of the more volatile ones like CIMB have come off, for example, and the winners here are RHB, presumably because of its yield, and also mBank, that is one of our top pick for our banking sector. Well, this chart that will need me to be explaining a little bit more. What we are trying to say here is we always ask ourselves, is a certain amount of the yield attractive? So yield means over here the earnings yield, meaning to say you take the earnings over in this case the share market, right? So if you take the market earnings over the share market total price or total market cap, the question that I like to ask is where are we today? compared to, let's say, in the past where there was crisis. So there are a few school of thoughts here. Some people say that Trump is a worse poison than a pandemic, because at least pandemic, there are rules that eventually you'll get out of it. But right now, people, there's one school of thought to say that there's no rules at all, so things are more messy than even pandemic. For us in Malaysia, I think because we are not so in directly exposed. My personal view is that we can still use pandemic as a guide, that we shouldn't be as bad as pandemic when our market fell to 1295. I would like to share over here is that earnings yield for the market back then during the COVID. So earnings yield, the higher the yield, the more attractive. So the earnings yield there, if I use the yield above our risk-free, that's about 4.2%. Today we're about 3.9%. So it means that if it hits 4.2%, we can say that wow, this is such a attractive market. Uh, at the moment, in my assessment, there's about a 7% downside risk. In conclusion, market is not exactly trough yet, but it's already considered relatively cheap. So that's why in our strategy, we have started to pick up quality names that are liquid. For example, we have recently upgraded CIMB and also Inari, as I mentioned. The question sometimes during stressful times, it might not be similar when we compare periods to periods. So for those who followed the market in 2015, 2016, there was also a period where there was weakness in US dollar. So there was a lot of outflow of US dollar, sorry, of money, right? So our so-called money in the system, i.e. your cash in hand, your deposits in the system, that started to leave the country. That created a M1, M2 sort of like a bit of a squeeze, and the banks were reporting some NIM pressure. What we are saying now in this graph is that the blue line shows the amount of cash in the money that is not being deployed into the stock market, right? It's taken as the total money over total market cap of the stock market. So obviously, the higher the ratio, it means that there's a lot more money that is not being put into the market. And for that reason, I believe that the moment things can turn pretty fast. So that's why I'm also not using a defensive mode at this moment. Furthermore, I think that Malaysia is also a beneficiary of stimulus. This is a chart of FBM's KLCI versus China PMI. As you can see, there's some correlation here. And China's GDP have most recent number looks quite encouraging. So I think as the stimulus has been kept dry in terms of kept the powder dry, this is also somewhere that we think that is worth looking. One area that we lack the conviction is still the smaller to mid caps, mid to smaller caps. As you can see here on the top graph, KLCI is the red graph, and the gray graph is the small caps. So I think over here, what we are seeing is that usually the performance of the small caps are usually more volatile both ways, and typically it will precede the large caps, especially in inflection points. So I think what we are trying to say here is that small caps typically will start to react first before the large caps. So that's one area that I'm monitoring. Just that at this point in time, we think that the visibility is relatively low in the smaller cap space, and therefore it's not enough that the stocks are cheap. There needs to be visibility, and in one of the spaces that we have done a lot more work is initiations of coverage in both Swift Energy Technology, which is a solar company, and also Pekat, which is one of the margin leaders in the solar space. Retail participation is still relatively weak at about 20%. We can see that during COVID time is 40%. So whilst now the market is also quite low versus the previous time, there is no so-called retail support, not at this very moment. So that's why the smaller to mid-cap space is somewhere that we cannot find very strong conviction on those reasons. I will just go into what are the sectors that we like. We like construction, plantation, and financials. Those are our conviction sectors. The ones on the right to those as energy and healthcare, respectively, oil and gas, and also gloves, actually. So what we have here is a correlation to the market. And this is just to help investors understand that if they get exposure into these spaces, anything more than one means you're more volatile than the market. So we are saying that we should be exposed, but we just don't want to be overly exposed at the moment. For that reason, and to avoid high volatility, that also flows through in how we think about our stocks. That's why we prefer MBank, which is more domestic, versus Maybank, which is a more external exposed, and CIMB, of course, exposed to Indonesia, and typically more volatile. Although we have power at the moment. On the domestic sectors, as I mentioned, I like financials. A lot of the conversations I have with the investing community is, why don't I go straight into telco? Why not just sell all my banks, buy telco, and hide in there and hide in utilities? Surely that will be a good strategy, right? In a very stressed environment with a potential of OPR cut. So I do get that question, especially from my fund manager clients. The reality is that not all OPR cut is a sign to go and hide and sell your bank stocks. There needs to be a bit of a distinction here, which is quite useful. OPR cut is a signal that the industry, that the economy is not doing well. So central bank reduces the OPR to stimulate growth. We have seen in two episodes in the 1 and 3 here, meaning the global financial crisis and pandemic, sticking with banks is absolutely going to underperform or do worse versus telco and utilities. So I think for those who manage your money as a portfolio, that is absolutely true in those years where the OPR cards, which is symbolized by this black chart over here, was very severe and much prolonged. That was when the red line, i.e. the banks, underperformed the blue line, which is the utilities, and over here this Kenanga and Pet Gas, and also telco, all your telco stocks. But that was not always true. In 2016, we saw Bank Negara also, because of post-Brexit, because of external uncertainty, decide to preemptively lower rates just by 25 bips. In that instance, there was no clear reason to change out of your bank stocks. Your bank stocks will still be good, right? So this is just to help paint the picture of whether or not an OPR cut in and of itself is a signal to sell all your bank stocks. I'll move on to our scenario analysis. We have stress tested our cyclical sectors. What we have done is not a very severe stress, but a reasonable stress. Again, I will just pick out a few things over here. For contractors and property names, we ask ourselves, what if the corporates come below guidance by 20% of what they have guided in terms of order book or yearly property sales, right? So in those situations, which offer you more value, and we're happy to report that in terms of earnings impact, the construction names are actually more insulated at this point. So we do think that the safest here would be IJM, followed by Gamuda in that sequence. In the banking space, which is the largest of the sensitivity to a weakening economy, this is a bellwether. So we think that if it's an OPR cut of 25 bips, currently it will not have a significant impact to our earnings. We estimate about 1 to 3% earnings cut. And over here, the ones that are more impacted will be AFIN, followed by RHB Bank. We think the least affected over here is Public Bank and CIMB in that sequence, and also Hong Leong Bank in terms of earnings. We do think, however, that the discussion on an OPR cut alone is insufficient because we are talking about tariffs, and this is exposure to somewhat of a geographic region, right? Trade loans. And so what we have done is we have canvassed the trade loans by looking through the financial statements. We think that at this juncture, the earnings risk to the banks, assuming there is a 10% increase in your bad loans, on average, they will hit the earnings by about 9%. But this 9% is assuming that it's all happening in one time. And this assumes that our trade loans here, which represents about 10% of loan book in general, this is still something that we will consider manageable because it could be stretched over 1 or 2 years to see this impact. Therefore, we are not too uncomfortable with our bank's picks. But if there is a concern on the trade side, we think AFIN is a little bit more exposed. CIMB, MBSB, likewise a little bit more exposed for its trade-related exposures in our view. We have come to the point where I've gone through scenario analysis. This where I probably flash out a few screeners if you like to take a look at some of the stocks when we compare this time around what the pricing and the valuation using a PE basis versus say the pandemic, Trump 1.0 or GFC. And we would be able to find certain stocks that are trading even cheaper than it was during the past few times. For example, PCAM, Nestle, these are certain stocks that are already quite beaten down on a price basis or a PER basis. And generally, these are consumer and planter names. These are mainly the 30 CI stocks. But if I was to go down further to the stocks that we cover, I think some of the screens show that names like Dialog and WCT, these are also considered quite cheap on a price basis or PER or price to book valuation basis. So for some of you investors who have a longer time horizon and you are looking for something more to invest in based on screening, these are some of the screen results we have. Of course, share price falling means dividend yield goes up. At this juncture, a lot of stocks do offer a return, promise a return of more than 5% based on the yield in and of itself, all the way from MBM resources from the top, even to some of the stocks on the near to the 5% levels. You see a lot of the REITs on the top half of the table, but you will also have construction stocks and banking stocks in there. However, we think that it's not sufficient to just look at stocks yield basis per se, but also to look at how sustainable is that. So we screen further for additional 2 years of earnings growth, not so US tariff exposed, and offers you more than 5% yield and have a decent market cap. Because that's where the fund managers like to hide right now, in stocks with market cap, right? So I think for that, this is a more detailed screening. And those on the higher end, we will highlight time.com, which is a name that we like in telco space. But the winner here would be LPI. LPI has a yield of about 6%, but because for those who followed the episode with Public Bank will know that after LPI has to sell the 1% stock that they hold in Public Bank previously, they have decided to pay out as dividends over 2 years, and the amount that they pay out is roughly 13% yield. So if you think about that, BAU, business as usual yield is 6% plus 13% over 2 years gives you at least 20%. So that's a good yield pickup if you're looking for a more defensive strategy at the moment. Yeah, so I think very quickly, just talk about some of our sector changes. For those who have been following our work, thank you very much for that, and we appreciate you. Just want to share some of the things that we have had to do with our portfolio. As mentioned earlier, we downgraded tech. We're not saying that tech is there's no hope at the moment, but there's a lot more overhang on semicon related so-called tariffs, AI exports, chip exports uncertainty. So we think that the risk reward is no good. We believe that this is an area that more trading sort of method is going to be more useful. We also think that at this juncture within our stock rotations, we believe that from our property side, whereas previously we have Marsing and Signprop, Marsing has and both have high upside. We think that Marsing is a name that we remove from our property pick because there's less visibility about their ongoing discussion on data centers. Whilst previously it was much talked about, right now it's gone a little bit quiet. So we are wondering whether there could be risk of model change within the data center plan itself. Therefore, whilst there is upside, we removed it from our sector pick. In renewables, we have rotated out of Solar Vest to Pekat. And the reason is because Pekat, while it's a smaller player, it has about 5% market share, about LSS5. What we are seeing over here is that we think we are in a juncture whereby a lot of public fund managers already own Solar Vest because now people believe that space is growing, but it's come to a point whereby people will be now focusing more on margins. So for that, Pekat is our margin leader, and we rotate into that as our top RE pick. We have also previously been contrarian in our call to buy PCAM. However, unfortunately, we have to own up that we were early in the call and were incorrect. And we bite the bullet here by moving into dialogue after knowing Trump's tariffs is causing pressure on oil prices. And when oil prices are low, and also OPEC is still going to pump up more oil from the ground, Dialog tend to benefit on the storage side. So Dialog is why we like the sector. Of course, on PPB, who is exposed to the China business, for example, through Wilmar, we think that currently valuations are at a decade low, so it's time to upgrade. Our non-consensus calls over here. Believe that among ourselves, we have Sunway. We believe that in this market, if healthcare listing and all that was previously driving a lot of the share price, the question mark with all this overhang will still be quite real, whether investors are willing to pay top dollar for, let's say, the healthcare asset within Sunway. So we are less optimistic. Affin, we believe, is a little bit pricey. We have added Unisem to ourselves because we think in the OSAT space, currently there could be more pressure given the rules changes, especially on the semicon tariff side. I think that being said, these are our overweight sectors. And neutral sectors and underweight. The ones on the left is those that we prefer the most. So renewable energies. I'll just quickly talk about it, and then after that, I'll open the floor for Q&A. I think renewable energy I've mentioned, Pekat is the reason it's not a market share type of strategy. It goes by good execution, tight margins. So we like Pekat even more than SolarVest at this point. For plantation, we have a plantation price of 4,002 for the year. We don't think that is out of the ballpark. Some of the brokers believe that stocks with downside risk could be those with oleochem, also called the downstream segment. Our channel checks with corporates reveal that the demand is still there. IOI Corp, for example, I think the downstream side still seeing good traction from Asia Pacific, Japan. So I think so long as the depression is not the recession doesn't hit in a severe way, we are still quite comfortable with more integrated players. So for those reasons, we like IOI Corp rather than just looking for upstream or just a play on CPO price. But rest assured, plantations, because some of them sell forward, the earnings for the next 1-2 quarters is where we have confidence, and therefore it's still an area that we think investors can stay invested. In the healthcare space, we are a bit contrarian in inverted commas because I think most like KPJ, we think IHH is the more interesting option over here. And also we think that the KPJ valuation has come up too fast, too strongly. And that probably needs to be find a little bit of a stabilization first. So for that reason, we think IHH is a better pick. Construction side, we believe Gamuda is the one that is still quite worthwhile to pick up because on the construction side, based on our channel checks, the likes of Gamuda, Suncon, IJM, there hasn't been any slowdown vis-a-vis data center inquiries. In fact, some of you who have been following the data center news will know that Microsoft has pulled out in certain areas in, let's say, Indonesia, where they have planned certain data centers, but they are not really proceeding. In that sense, we think at least on the Malaysia side, things are still quite visible. So these are some of the sectors that we like, and those are some of the key picks. I'll just leave this chart here as well to just give a canvas of what we like on the large cap space and the small cap space. So on the small cap space, PIE is one of the names that we have put as a pick for second quarter. Keyfield as well is on the upstream side, is the only name that we like at this current moment because its vessels are relatively new. So when the cycle comes back around, this is also one of the names that should rebound very quickly. So I've spoken about Pekat. Intex is our water play, given that tariffs on water could be increased. And SLP Resources is our sole name in the plastic and packaging space because it is a niche, has a niche market, and therefore it's not entirely exposed to US, for example. So I think that brings me to the end of my presentation. I've got a lot of useful sector slides as well, if Adrian or anybody who wants to ask me. Yeah. Adrian, I'll pass the time to you for a Q&A.
Wow, thanks, Peter, for the insightful sharing. And you know what I really appreciate the most is how you have just pointed out how things are going and how our research in is actually taking the view that we are not going too defensive. Most importantly is we you actually gave the step on how do we take the step by baby step and step by step to screen for quality stocks in this volatile time. And I think that's just amazing, you know,
I do what I can, Adrian. I do what I can. Yes.
fantastic. I know, I know. Okay, I'm bad at imitating Trump. Failed. No comedian. But yeah, so
Yeah.
so without further ado, let's jump to the first question from the Q&A side. Then we will move to the chat box. And yes, before I jump into it, my laptop is lagging. I've just posted a survey link. You guys can actually complete the survey and put your email at the item number 10 so that we can contact you if you are the lucky winner for our Shopee voucher. There's 3 up for grabs. And yeah, so without further ado, let's go to the first question from the Q&A box. The Trump 2.0 seems to tickle the panda period and where the result of the tariff is as it is. So how, in short, the panda is now potentially in the bear trap, and how can we protect our investment? This is actually a very on point question. How can we protect our investment in this volatile market?
Yeah. Thanks for the question. So Adrian, if I hear you correctly, the question was more about how do we protect our investments in this market in general, right? It's without specific
Yes.
in
Yeah.
general. Okay. Yeah, I think if I was to give some feedback for investors, because I deal with the institutional fund managers a lot. I know their current psychology. Just before this, a lot of investors were already cashed up at about some of them even holding 20% of cash in their portfolio. Usually on good normal days, it'll be 6 to 10%, but 20% means people are already very scared, right? So I think number one, obviously we need to be more risk averse in that the capital allocation. Some of this monies are being set aside. As we saw, some of the institutional funds, that's what they are doing. So at the moment, people are staying in the sidelines, but does that mean no? Because the reality is that even the fund managers that I deal with believe that at this current moment, there isn't a huge reason for breakout either on the upside or downside. So based on news flow, people will just sell into strength, and when it's cheap, you will buy, right? So I think currently, if your question is how do we protect our portfolio, I would say that number one, asset allocation in terms of how much cash are you comfortable with. So and number two, I believe this is also a moment that the market will be trading. So be careful not to chase, because the big funds out there are necessarily looking at as a bit more, I would say, a trading thing. So just because there's momentum, it will not really last. So chasing is not really a good strategy right now. The third thing is obviously looking at dividends. I think the thing here for dividends is also not only you should look at dividends in and of themselves, but whether the dividend stocks themselves promise you some form of growth, at least for the next 2 years. So some of the stocks here that we boxed up fit those criteria, and definitely we'll look at that. I think finally, to protect our portfolios, there's no secret. I think those that are now more domestic focus is still what investors like to hide in. So in that sense, your healthcare, your utilities, and the telco sector will provide you the best so-called protection. Obviously, shelter. If you are more risk averse and you think that OPR cuts or the GDP will be even more affected, rotating into telcos and utilities has been a winning method in those years. Although in our current strategy, because we don't expect a deep OPR cut, that's not something that we are pushing very hard.
All right. So that is another insight that sometimes we might have missed, which is how do we maintain our cash ratio, and this topic is something that most of us would have neglected. And really, thank you for that, Peter. So let's jump to the next question. This is a question from Calvin. Why select 10-year MGS compare against KLCI and equity yield?
Yeah, I think thank you for asking that question. It's a bit technical, right? This question. Essentially what we are trying to say here is that um it's a measure of how much more yield is required to entice somebody to put money into the market, right? So that's actually what we are saying. If we was to look at the for example, the argument of FD, for example. Today you can get FD at 4%. But if I say, if the equity the premium that you pay for getting into stocks, if I can give you a 7% return, will you be happy? Right? So that's actually how we think about it. But we cannot think about it in isolation. We need to think about it in relative terms, right? So 7% you can get equities, but let's say 4% is FD. Guarantee get the money one. But what happens if today the FD rate is so good that maybe it's 6% and your equities is 7%? The rational person would then choose the FD, right? So actually, I'm just using that as an example. Instead of FD in my illustration, I'm using MGS. So I'm just saying that the returns that the investors need before they come into the market in the past was about 4.2%. That means at the time, the MGS was about 4%, and then let's say another 4% on top of the 4% MGS. If I was to offer a 4% yield on the earnings, that is when some of the foreign investors will start to nibble into the market, right? So that's just helping us frame it up to see at what level of returns does it then make sense for investors to so-called maybe not buy bonds, maybe come and buy equities instead. So that actually helps me frame when I think market is cheap or expensive.
Okay. That's a way to look at. Normally, I'm more bottom up, so I never really figured that out. So that's something to learn.
No, yeah, it's
Thanks,
just
thanks, Calvin, for
knowledge
highlighting
sharing.
that. Yeah, and I love it because every one of us here is learning through how to manage our wealth better. And yeah, So the next question that let's jump back to the Q&A side. It will be from, let's see, Chu Tai. Okay, James, we normally do not share the presentation slide, but you can actually tune into our YouTube link. Massing gloves, how is their performance? Okay.
Yeah,
That's
yeah, thanks for that question on massing gloves. As I must say that I have not gotten an update. However, I think what we have seen is that the glove makers' feedback so far has been quite in unison. In fact, back to my survey here, within this seeing more inquiry segment, the one of the respondents is Marsing as well. So they have also said that they are seeing more inquiries. Hopefully, this gives you some insight. However, I apologize, I don't have the most recent update as to their financials because I cannot remember it offhand. Yeah.
all right. So,
Maybe I'll just talk about gloves now, since there's a question on gloves,
yes.
Adrian. So on the gloves question, currently what we know, as I mentioned earlier, even today we had a session with one of the big glove makers for lunch. I think what we have also learned is that there's a lot of inquiries, just that but in the US business, they have not actually seen new take up yet in terms of orders, right? So I'm a bit impatient. So I asked analysts to also work out if it is because they have too much stock, when will the additional stock that they front loaded from China eventually go away? Right. So I think the concern here for most of the glove makers is volumes are going to be slow and ASPs are not coming back. As far as we understand, in the first quarter results briefing by Top Glove said about 2 billion that gloves that they usually sell to the US, they didn't manage to sell that quarter. So our mind, we started working it backwards. We think that whatever is lost by Top Glove is actually won by the Chinese, for example, on front loading, right? Say the Chinese throw price and sell to the US first. In that case, if we work it backwards, 2 billion and Top Glove has 23% market share in the US. Malaysia glove players altogether have about 50% market share. So when we work out the math, we think that the total front-loaded gloves is about 8 billion pieces in the US. US demand in a year is about 80 billion pieces. So if you do the 8 over 80 and you take it by number of months, it's about 1.5 months. So that helps us a lot, because what we think is that we can use this as a general guide. If the front loading has been very significant in up to February, that means this 8 billion additional pieces that were front loaded will probably be exhausted by somewhere end April. Then that is when it means that during that time we will have confirmation whereby the Malaysian gloves can start to increase ASPs again, for example, on their new orders. So once we work out when the order depletion happens, we can anticipate when the ASPs will go up. So in our view, maybe May or for further from there, we will then see some ASP uplift. That's why on a 12-month basis, whilst the glass stocks so far has been a bit of a disappointment, in at least for the past couple of months, we hold on to it as an overweight call. And although I'm not answering in specific massing, I'm just giving you a so-called industry update. Yeah.
Wow. So I just took a quick look at my calendar and already in mid-April. So that's not too long of a wait, actually. I think that's great news, Peter.
Mm,
So let us jump. And I think to observe a bit more before we react is also should be a good strategy, right?
yes, that's right. That's right. That's why in the second quarter strategy, we're not saying buy now. We're saying that keep a powder dry. There will be a time that you can jump back into gloves. Maybe in May we can start to think about it again, lah. But I don't want to so-called look at it as a fundamental buy at this very moment, and we need to see how things develop. So therefore we say that this quarter we stick with some of the safer so-called sectors lah. Our glove view is a tactical one, meaning to say that we are very surgical of when we want to go in. Similarly for our tech space lah. So in our tech space, what we think is that because the news flow front is volatile, and the news themselves can change, right? Out of US, Biden say
Yes.
one thing, Trump says one thing. So I'll just flash this so that it gets recorded in our YouTube as well. Where these are the names that we cover. We know that fund managers are also trading ranges. So this is the top is just the so-called price earnings ratio band by standard deviation, and what would be the so-called prices that is equated to. So we know that currently Inari, SK Press, and all that are now trading at about -1 to -1.5 standard deviation. Probably there's opportunity to take a more trading related view. Something I don't normally say, but in this environment, it probably we have to play with what we are given.
Nimble, a bit more nimble also. Yeah.
Yes, yes.
All right. So there are some more questions. One is from Yap Ching Ting. Um, what about F&B stocks like Oriental Copy?
Right. Oriental Copy is a well-liked stocks. Of course, I can't conclusively say because we don't cover the stock. We do get a lot of questions. I think right now, if you ask me, the business model is something that I really like. I think that the fact that they are stocks, their so-called shops can actually make back their money usually within 1 year is a sign that they have a lot of getting a lot of the formula right now, right? And currently they are also moving into like coffee powder and all that. And you can see, Adrian, if you go into the shopping mall, you buy one of the coffee, it's double the price of the other coffee
Yep.
brands, right?
Yeah.
So I think definitely it is in the sweet spot, pun intended. And I think it would be a name that I personally find to be relatively interesting. I just cannot say, buy what TP because I don't cover the stock at this point. Within the consumer space, if you allow me just 1 minute, I would say our conviction is not high, right? So position sizing is also important. What we have done is, this is a little bit nerdy, but we ask ourselves, right now the concern is the macro. So what happens if the macro is a bit weaker? If I use a statistical model and I look at the past 30 years, usually when the market is GDP, for example, is weaker, what should the total impact be on, let's say, the KLCI consumer stocks, right? So we believe currently that the consumer stocks projection for revenue of a 5% growth is still relatively high. Our model assumes maybe about 2 to 3% growth. So we think that at this very moment, there needs to be a little bit more of recalibration, a bit of expectation first, before we can say build a more convicted position. So on the consumer side, we are generally neutral. Our topic is F&N at the moment.
And I saw Mr. DIY is also quite active today.
Yeah. I mean, maybe since you brought up Mr. DIY, I will probably use this opportunity to talk about our consumers scenario analysis. Whilst
Nice.
we have so-called stress on the downside risk for property and construction and banks, on the consumer side, actually they are the relative winner. It might not be very gone a lot into the news that just on 2nd of May, for example, any Chinese product that goes to the US previously, if it's just below USD 800, right? There's something called a de minimis exemption, meaning to say you don't have to pay custom duties. But by 2nd May, right, that is in place already. Trump say cannot. We will collect tax from you. So if you think about it, these small items, they have to find somewhere to go, lah, right? So we think for that reason, Tadini, Mr. DIY, they actually source 60-70% from China. So if the idea here is that they could have a stronger bargaining power, every 1% that they can save on their material costs will actually translate to about 4% increase in earnings lah. So consumer space, in all that has been said, is actually relatively better off after Trump comes in.
That's comforting to know. Really comforting. Okay, last question. Actually, last two. First is what's your view on the USD versus ringgit? And also, do you think that PCAM still have hope? That sounds a bit morbid, but yeah, that's the
Yes,
last word.
maybe I answer the PCAM first, right? And then after that, I'll talk about the US dollar. PCAM is not a stock that we PCAM is a stock that we believe at this juncture is affected by two things, right? So number one, the first of it is the tariffs. So on the tariff side, what we have previously thought before the tariffs came in was that this year there would be a chance for a turnaround in PCAM because we believe that there's on the supply side there will be some plant maintenance and turnaround in the market, so supply will come off. We also believe that when the US industrials ISM, basically a gauge of manufacturing activity, once it passes 50, usually it also brings up your prices, your selling prices of your PCAM materials, i.e. your PE and PP, polyethylene and all that. That was going to be our thesis moving into this year, where we thought that it's cheap enough to go in. However, with Trump in the picture, currently what is happening is that the manufacturing indicators will likely weaken, at least for now. And we also think that the PP or PE prices are mainly will likely not be able to re-rate as quickly as in the past lah. We initially thought that it will hit about 1,100 US dollars. We have lowered it by a couple of hundred lah at this current juncture, which means that we are seeing it flattish and no pickup. But the bigger problem for PCAM, and why we believe that at this juncture it's still not safe to go in a big way, is because we don't think first quarter results will be good, because they have been struck by plant issues. So
Right, if I
yeah,
recall.
and yes, correct. So the plant issues will surface in the first quarter numbers. And our analyst Syncate has done a lot of work in it. In our website, you can read about the entirety of what's happening on that plant side. But essentially, the PCAM gets its feedstock from Petronas, right? And that Petronas plant cannot give it enough feedstock. And per my understanding, that has also caused some hurdle in terms of utilization rate of the PCAM plant, right? So because of that, they are indirectly affected, and utilization will be low. And usually when utilization is low, there's always tendency for losses. So I think in that case, we want to just share with the investors that there is still this risk, and therefore on a signal basis, we don't want to call it a buy. Although we recognize that for a longer term shareholder, it's now currently trading at about 2 standard deviation below below book, and it's also one of the stocks that is cheaper than pandemic and Trump 1.0 lah, So in that sense, we don't think it's expensive. We just cannot call it a buy because we think that there's still some risk that we need to go through first lah. Yeah, I hope that gives an understanding of where we are at in the stock. Yeah.
One more minute, Peter.
Yeah.
USD and yeah.
Well, USD. Sorry. I forgot about to answer. Okay, so on the USD question, we in the top of the meeting, I laid out the econ scenario. We think that at this point in time, the USD will be at 4.45 for this year, as you can see over here in this chart. 2025 4.45 over here. I understand that we are also expecting this to go to 4.2 next year. I have a chart that I don't have over here. Essentially, we look at the differential between the MGS versus the US Treasuries. Currently, we are at the level that is consistent with the US dollar being at about 4.45. If we take into the account that we have two US rate cuts, currently the market is calling for even stronger rate cuts. I believe within the broker side, our 4.45 is not considered aggressive, but we do think that after it reaches 4.45, only on two US cuts, we think that as we go into the next year, that's when it will take another step down to 4.2. So based on that, I don't think I have a very strong conviction to say, oh, buy ringgit strengthening beneficiaries, because we don't see a very drastic and straight down type of phenomenon, but it's going to be a bit more gradual. I think in that sense, usually the businesses self-adjust quite well.
Okay. Okay, that's awesome. Yeah, I guess that
I know you're eating into my time, Peter, but don't worry. Answer the question about gold.
gold, gold, yes,
Yes.
gold. Should we buy now? All in
Ah,
or
So
not?
we have a question over there. Which gold stock or gold ETF should we consider?
By the way, guys,
So
we need to tambah 5 minute or 10 minute. Okay,
we will do our best to finish on time, all right? But right
I,
now you've come in on a perfect timing. So answer the
um,
question.
okay, Isabel, I take your point. Next time when we flash this forecast and assumptions, I should put gold inside here as well, as just to give some sense. I think I don't want to call this an official Kenanga number, but I know when I discuss with my econs team, we think that there's still upside to gold, right? And I don't want to put our number, but it's definitely closer to 4 than closer to 3, right? That's where we think it would be so-called in the near term. I think as a house, we are also on this trail. We think that in the market, where the gold price is high, the question is, do you own jewelers or do you own, let's say, pawnbrokers, right? Because the risk is a little bit different here. One is you warehouse the risk of gold, and the other one, you are sort of earning a so-called margin on top of the gold, right? Let's say, for example, let's say if you are a Pokong or Tome, you buy the gold and then you create a very nice necklace. So you're sort of like earning a margin on top of gold, right? So that's one way to play it, but you're essentially taking still a gold spread on top of gold. The other one that we like a bit more is playing through, I would say, the uh pawnbrokers. So among the pawnbrokers, like Papa Jack, Wellchip, the one that we have recently done some work is Wellchip. So Wellchip, we have a ad on this name. This is a name that previously has been just more focused on Johor, and currently they have gotten more license to expand beyond Johor, and they are now going to increase at least about 6 more shops in addition to what they have, about 20 at the moment. So that's going to give them the growth that they were so-called lacking after their IPO. If you recall, the IPO came in, they had proceeds, they were unable to quickly deploy because of licensing, and that is starting to unwind already. So I think if you take a view that in a market where the gold price is relatively high, this will allow them to be more flexibility, and also so-called give out more loans on the back of a higher collateral. We are expecting that growth to come from this phenomena, and recently we have recommended to add on Wellchip. Yeah.
Oh, so they are really well cheap, huh?
Yeah. So this is just one of the ways that we think we can get leverage to gold play without directly buying gold itself. Yeah.
Okay, thanks, Peter. Thanks a lot.
Overwhelmed by the puns today. Just know there was bargaining chip, there was
Yeah.
sweet spots.
Yeah,
Oh,
exactly right. That is a play on words of the day. Words of the day.
I didn't know
Sorry,
you were one for
Isabel.
dad jokes, Peter.
I must have overstayed my welcome right now. Perhaps this is where I take down my my slides and say thank you for the investors who have given me your listening ear for the past hour. I hope it's been useful. Thank you.
Without further ado, let's welcome our gorgeous warrant issuer, Isabelle. And yeah, the floor is yours. Sorry for the delay too.
No problem. I was as eager as you guys are to listen as well. Peter, thank you so much for your excellent session and your solid moderating, Adrian. Since I only have 5 minutes, well, three with you guys, I'm going to summarize really quickly about the warrants that we're looking at right now. So, the disclaimer Adrian has mentioned earlier, and yes, Peter, Adrian, and myself, we are licensed. So licensed by the Securities Commission for me, CMSRL 6 and 7, Module 6 and 7, and Adrian as well, if you want to be pedantic about it. So for the warrants, quick thing, as you know, the coverage that Peter gave was more of what to buy, right? Which stocks you should be looking into. Warrants are the product that offer you leverage and a cheaper entry point into these products. However, warrants, I need to warn you, they are incredibly complicated. I know they look simple when they are listed, but they are wildly complicated. They are, I can say it's the most complicated derivative available to retail clients. So I've spent 9 years issuing warrants as a warrants issuer. And I can tell you the frequently asked questions, the easy way is to just to check out our YouTube. It is at Kenanga Group. We've answered all these questions. I've covered all of these into short 1 minute videos that you can check out over there. So do check those videos out. It is at Kenanga Group, YouTube. And yeah, all of these minute warrant videos, they're about 5 minutes over there for each question. So you can always scroll down to the question that interests you, structured warrants versus stocks. What is a structured warrant? Can a call warrants go up, go down while the market goes up? All funky questions. I've already answered them on YouTube. So what I mentioned earlier was Peter covered this. Fundamentals tell you what to buy. And you can actually look at those warrants that Peter covered. You want this is a perfect opportunity to take a quick screenshot. We've got a M-Bank warrant, a Gamuda C3D, Tenaga C3A, MBMR, and Harta C2U, which is also available on our Naga warrants by Kenanga Telegram that we update every single day. And the technical is more of when to buy it. And this one is lovingly done by our personal research analyst, Adrian, where he talks about, well, not technical analysis is all of the stuff you need to know. But if, say, you don't know it, quick shortcuts would be to look at the Naga Warrants Telegram, where this is the excellent trade records. I can say if you just look over here, out of one, two, three, four, five, 4 out of 5 ideas are winners. So do consider looking at the trade ideas that we post every single Monday. This week, the trade ideas are on Inari, Natgate, and Supermax. There's a recap over there. And also for Hang Seng, we do offer trading ideas on Hang Seng. But I was going to cover a bit more, but since I wanted to give you guys more time with Peter, I just want to remind you that warrants are inherently risky, and perhaps I'll cover this more in my next session next month with you guys again, or with the Rakuten session that we have every single alternate Tuesday. So maybe just a little tiny bit. I know there are a lot of advantages that people talk about for warrants, and they always say it's risky, which is, yes, true. But once you actually know which risk you're fighting against, for example, time decay risk, you fight against that by considering not choosing warrants with more than 1 month to expire or less than 1 month to expiry. Gearing risk is a double-edged sword, but the benefit is there's no debt, there's no margin call for warrants. There is market risk, which is systemic versus unsystemic risk, liquidity risk, which is lowered when you choose a good issuer, like Naga warrants. There is volatility risk, of course, issuer default risk. Well, I've been here for 9 years, touching 10 at Kenanga. My blood runs red. Adrian, how many years have you been at Kenanga?
14. Yeah.
Yeah, 14. So the chances of a issuer default risk at Kenanga is very low. If not, we wouldn't be here a decade later. Am I right?
Yep.
Extraordinary price movements, yes, that happens, but your capital is very little. You use limited amounts of capital, so you're protected against that if you manage your risk reward ratio, as Adrian always mentions. And of course, Forex risk exists from Malaysia to Hong Kong dollars if the Hong Kong dollar depreciates in relation to ringgit that exists. But the easy way, the last thing that I want to just remind all of you is that yes, there's advantages, there are risks. However, using the Musty strategy, which you can check out on our YouTube, it discounts many of these risks already. For example, M, if the issuer has no matrix, you forget to look at the gray and white zones, you never notice the traffic light colors. E and S, you can balance those. Those will help avoid buying warrants that never move. T, you will avoid having expiry issues. And I, ask the issuer questions or ask Isabelle questions.
Uh,
So that wraps it up, 9:33.
yep.
And thank you so much, Adrian. And thank you so much, Peter, for your time. And ladies and gents, may
Oh,
we cross our hearts, look up to the skies, and wait for Trump's next tweet.
yep. But before we call it a night, I think there's some question which regarding the matrix from Calvin. Does a light amber color indicate stock liquidity? And by the way, I think
Good
I
question.
really love the matrix that you showed earlier, where it's really informative. I think it's on the top slide, right? That's where the
Mm,
matrix is. Yeah.
yeah. So sorry, I've been talking about warrants for 9 years. So my slides, I have like 600 slides if I'm not careful. But today I just put a chunk up for you guys. So whenever it's amber, the real issue is whether you can buy or sell. A quick explanation would be, I don't have the slides here right now. Do I? Okay. So I do have an example slide over here. So the issue with the amber warrants, which is what he means is this orange color line, that was what happens, is you got your bid and your ask, right? Am I mirrored correctly? All right. Bid and ask. So whenever an issuer runs low on inventory, they will maintain the bid so I can continue buying from you. But let's say the bid is 10 cents and the ask is 10 and a half. The offer is 10 and a half. I'll increase the offer to maybe something ridiculous like 15 because an insane person will only buy a warrant when it's 10 cents on the bid and 15. The spread is ridiculous. If you see a money changer with that kind of spread, you won't go and buy, right?
Yep.
But you can always sell back to the issue at 10 cents. Just that I do that, I pull it apart. But sometimes people do queue in the middle when I'm running out of inventory. And that causes the what you see on your Kentrade to have no gap. It'll be 10 and 10 and a half on the offer, 10 on the bid, 10 and a half on the offer. So therefore, it might be deceiving. So you might buy the wrong price.
Mm.
So that's why there's the orange color whenever there is low on inventory for structured warrants. So yes, to answer your question, that's why we have this feature on our website.
That's a fantastic feature. I don't think I see it out there, man. But yeah,
Thank you. You're
really
welcome.
nice.
It came out of
Traffic light is
my
very easy to,
yeah,
normally
it
I.
came out of my brain one evening. Mm.
Nice. So let's do a quick run if there's any more question. And there's one more session of Shopee vouchers to be given out. Tell us which structured warrant you'll pick from today's session, that which is where we have a link on the chat box where you can actually click on Facebook, follow the instruction, and you may stand a chance to win it. So quickly check. Let me do this quickly. Yeah, I know we are running a bit late, I know. Okay,
Five
I
minutes
still,
will
still
survive.
can't mimic Trump, so failed comedian. But yeah, so far I think there's no more question. There'll be some leftover question like from Augustine on Gunting. I will try my best to try to seek some answer for you. Oh, one more last one. I think are warrants identical to options from James?
Warrants are a type of option.
Hmm.
To answer your question, it's under the options family. Warrants are more like one of the grandchildren of options. The difference is for options in America, you can write your own options as well. And it's structured roughly the same, but for warrants, they are a type of option, if that makes it clearer for you. But they're not the same thing. They're like a cousin, maybe.
Cousin. Yeah, I think it's cousin also. Same, different. Yeah. Okay. Hope that answers your question, James. Cousin and siblings. But yeah. So I think thank you for you guys for your patience, guys. I know you guys are really awesome. Thank you for tuning in. Since there's not much question that is relation to warrants, I think we will call it a night. And again, I'd like to thank all of you for spending your time tonight where we can learn together. And thank you a lot, Peter and Isabelle, although we are squeezing a bit tight on Isabelle's slot. Yeah,
It's a worthy thing for Peter's insights. He only comes online 4 times a year for us. So
yeah.
thank you, Peter. We appreciate it.
The most handsome
Get some
musician.
sleep, please.
All right. So I'll see you guys on our next session. Do tune in. Like what Peter said, there could be signals. So follow us really closely. And you can also check out our Naga matrix where we have our traffic lights on for you guys. Okay, going offline. Bye, guys. Thanks. Good night. All the best.
Stay safe, guys.